Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. In the last two episodes, we talked about expectations and about how markets honestly don't care that much about where the company stands today. They probably care more about where they think you're going. And today I want to take that one step further because when investors look at a company, there's one question always in the back of their mind. And that question is, how long can that performance last? How long before competition catches up? Simply, they're asking how sustainable and durable is your competitive advantage? Now, here's the thing. Creating a competitive advantage in the first place is hard enough, but sustaining it, keeping it alive over years or even decades, that's probably the real challenge. And investors know this because they've seen the patterns. They've seen companies enjoy high profit margins for a few years only to get challenged by new competitors. And they've seen products that look untouchable on paper, but disrupted by something new. And they've seen regulators step in and say, hang on, this industry is making too much profit, so we need to interfere. So when investors evaluate a company, the real question isn't if they have an edge today, if it's this edge is going to last for 5 years, for 10 years, maybe 20. And that's what's usually called the competitive advantage period or the CAP. It's also sometimes called the growth appreciation period or the GAP. Think of it as the window of time during which a company can maintain above average returns before competition starts, eating away at it. Now, and let me pause here. This isn't a small topic because entire libraries have been written on strategy and case studies. But for today, I just want to make it practical. If you're a corporate leader or an executive, maybe new to fundraising and capital markets, maybe not, this is the lens you need to know that investors are using when they look at you. So let's start with the widest angle, the macro view. Investors step back and ask what's happening in the broader economy and how might that affect how durable your advantage really is. Think about demographics. Young population in Saudi Arabia, for example, an aging population in Europe, both are huge demand drivers, but they push in really different directions. One might increase demand for healthcare and pensions, Europe. The other might increase demand for entertainment, housing, consumer goods, Saudi Arabia. Also think about industrial policy. Governments can change the playing field, right? Take the Gulf right now. There's a huge push towards AI and tech. And if your company rides those cycles, your competitive advantage might actually extend longer than expected. But if you're in a sector that governments want to open up for competition, the opposite can happen as well. And there is the financial backdrop, things like interest rates, access to credit, cost of capital. If money is cheap, new competitors will join. The bottom line here is that even the best competitive advantage can be eroded if the macro landscape shifts. And investors know that no company lives in a bubble, of course. And that's why they map these big forces first before zooming in. So the industry. The industry itself tells you how the game is being played and what the rules of the game are. And here investors ask if this is an industry where a competitive edge can last, or if competition can eventually wipe out returns, no matter what you do. The classic examples here are airlines, in my view, capital intensive, heavy competition. Even the best well-run airlines can struggle to sustain returns. And this is where Porter's 5 forces come alive. And no, it's not just MBA jargon, because investors actually look at them. How much power do suppliers have over you? How much bargaining power do your customers have? How easy is it for new entrants to join the game? Are there product substitutes? And is there rivalry among existing players? Investors know that even a well-run company can struggle if it operates in a very competitive industry. So again, investors want to know if the industry is a playing field where competitive advantages can sustain over extended period. All right, so let's say the macro backdrop looks great. Let's say the industry is at least structurally, attractive. Now, investors zoom into your company and ask, what are the actual sources of competitive advantage? And at the simplest level, there are 2 ways to earn above average returns. If you recall our earlier episodes, you either charge a premium price, you operate at a lower cost, and sometimes a mix of both. On the price side, there are 5 common strategies. The first is innovation. Think Kareem in its early years, building a ride-hailing platform tailored to local payment methods, cultural norms, and regulatory environments. It was hard for global players to replicate quickly, so someone like Uber acquired it. The second is quality. Think Emirates Airlines, for example. Emirates Airlines charges a premium fare because of the quality of service. The third is brand. In Saudi Arabia and the broader region, Al-Marai, of course, a very well-known brand. Al-Marai is a brand that customers trust, so it commands shelf space and pricing power, relatively speaking. The fourth is customer lock-in, or what I call captive market, captive demand. In telecoms, for example, STC, or do. Customers are tied in through bundled services and reward programs. And switching can be a hassle, so people stay. At least this was the case in the earlier years. And the fifth strategy is price discipline. The classic example here is OPEC, where the industry leaders are actively managing capacity and pricing floors in oil markets. Now, let's move on to 4 ways to cut costs or improve capital efficiency. The first is process or business model innovation. For example, Noon invested in logistics and last mile infrastructure that reduced fulfillment costs in a region where delivery is complex. The second is unique resources, and the best example I can think of is Saudi Aramco. Saudi Aramco pumps oil at a very low extraction cost, and that is thanks to its geological advantage. And that is a structural edge no one can replicate. The third is economies of scale. Think SABIC. SABIC produces chemicals at a massive global scale, and that gives it a lot of bargaining power on feedstock and distribution. And the fourth is scalability. Streaming platforms like Anghami, for example, already built its infrastructure. So adding new customers comes at a lower incremental technology cost. And then there's a hybrid strategy, what's known as the network effect. And that affects both price and cost. Think on-demand delivery platform Talabat. The more customers there are on the platform, the more it attracts restaurants, the more it attracts riders. And the more it has restaurants, the more customers join the platform. But investors don't stop there. They ask, okay, you have an edge, but for how long? That's a major driver of valuation gaps, by the way. A company with a 5-year competitive advantage period looks very different than one with, say, a 20-year competitive advantage period. Some signals of durability include a growing market share, stronger customer retention, increasing pricing power. The one example that pops is Microsoft Windows, because once they've been established, it stayed for decades. On the other hand, signals of erosion include things like competitors growing market share, new technology disrupting the industry. And sometimes high earnings growth hides value erosion. And we've seen it. You're growing fast, but at lower returns, or by cutting prices, or by spending heavily to defend market share. And smart investors see through that. So how do investors test whether a company's competitive advantage is real? Well, the shortcut is they go to the numbers. Numbers don't lie. If volumes sold are increasing, if profits per unit are expanding, if profits are actually converting into cash, and if the returns are actually attractive, they exceed the cost of capital year after year, then something real is protecting that business. If not, then the competitive advantage may not be as strong as it looks, or even sustainable. So what's implied here? Well, the key point to make is that investors can't be left to guess what your strategy is, or what your competitive advantage is, or how you plan to sustain and defend them. The point is that companies must prove, not just with strategy talk, but with numbers and consistent actions, that they can stay ahead when competitors are trying to catch up. Next episode, we'll take this further. We will discuss the signals companies send, and we'll look at how information gaps and perception games can move valuation. I am Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.